all that stuff. So it's kind
You
of
are the Joe Rogan of Halifax. This is cool.
well, I mean, I don't know.
Yeah,
Maybe
the same
someday.
barber.
Yeah. Same barber, right?
Yeah.
All right, man. Well, let's jump right into it. So I want to welcome John Vo to the show from Premier Mortgages. So thanks so much for coming on, John.
Thanks for having me, Chris.
Very welcome. I know we've been talking about get you out here for a little bit, and here we are, and got a couple things to talk about, especially in the recent news. But before we dive into any of that, why don't, for the viewer's sake, kind of give us a little bit of a high-level overview of yourself, kind of your background. I know we got a few things in common from our past as well, and maybe just give us kind of a high-level synopsis on maybe some past experience, education, and maybe what led you into the mortgage industry.
Yeah, sounds good. Thanks for having me, Chris. So yeah, I whenever I explain where I'm from, I always do it in two parts.
All right.
Because I'm born and raised in Yarmouth, but whenever I say I'm from Yarmouth, people are kind of get a funny look. You don't look like the average guy in Yarmouth. So I'm Vietnamese background, but was born in Yarmouth. My parents were Vietnamese refugees in the late 70s, early 80s, and they were kind of brought to Canada through community in Pumlico, which is not far from where you're from because you're from Argyle, right?
Yeah. It's basically like Halifax, Dartmouth.
That's right. Yeah. So the community of Pumlico is great. The nicest people in the world, honestly. And so my parents moved there in the early 80s. There's no hospital in Pumlico, of course. I was born in the Yarmouth Hospital, and then my family migrated there. My parents had different businesses. They had a convenience store, rental properties. Dad had a lobster fishing boat at one point in time.
Did he?
Yeah.
Okay.
A little bit of everything, My parents had no choice but to be self-employed, right? Because they barely spoke the language, didn't have much education. And so they came to Canada. They started working at Dion's Bakery, actually.
Old Dion selling the Roppy Pie.
Yeah. So I always try to pick up some Roppy Pie when I'm at Sobeys. But
the old Acadian staple.
Exactly, right? And so Dad got into just different businesses, and it's good. It taught me and my siblings a lot of hard work and work ethic. To be self-employed, it's not easy. So I have two sisters and a brother. And so we're all grown up doing our own thing, but we're doing quite well. And you know what? We have the community of Pumlico, Argyle, Wedgeport, and Yarmouth to thank for that. It was really good growing up in Yarmouth. And a lot of people will ask me that. They'll be like, how was it growing up in Yarmouth? There's not a big Asian community. And I got to say, like, everybody was very welcoming. It was good that our family could bring some culture to the town, because smaller towns don't always have that much culture.
We don't have much melting pot.
No, not really. So it was good, but everybody embraced it, and it's nice. It's nice. I don't get home often, but when I do, it's nice to see people, and a lot of people are happy to see me and my siblings, my family doing well, and it's great. So yeah, grew up in Yarmouth. It was a great place to grow up. Was involved into a little bit of everything, a lot of sports, which I think is good for people.
Definitely.
Young guys with a lot of energy. And sports was great, so I played a lot of school sports, volleyball, soccer, badminton. I was involved in martial arts. So I told you this, Chris. So I have a second-degree black belt in Taekwondo.
Awesome.
I was quite competitive in that. Competed nationally and was quite involved in that. And it was great. It was really good to have that. I know you train jiu-jitsu, right?
Yes, sir, yeah.
I think it's good to have that, that knowledge, that ability to kind of just hold your own, you know what I mean?
Yeah. I mean, I think martial arts in general is a good tool for people to have in terms of self-discipline, self-control. And it's very humbling and everybody should be able to defend themselves and, not like you're supposed to be running around fighting people or anything, but it is a good outlet and a great community. And, I don't regret any of the other things that I've done. I've done a an array of different things as well. I was heavy into hockey as a kid, and I think I shared some of that background with you. And as I kind of moved through that and got out of minor hockey and got into university, kind of fell off out of the team sports sphere and kind of really got into the weight training. I don't know if this was kind of consistent with, your upbringing, but like back in Pubnico, Argyle, it was like the strongest guy was the coolest guy.
Yeah.
So I kind of, for some reason, like just broed out and like we just went full force in weightlifting and weight training. And then that translated into getting to the bodybuilding scene and powerlifting, which I really enjoyed the discipline of just me doing the work and getting the result. But quickly, I guess over the years, I started to realize that maybe I was lacking some community. And I kind of fell out. I got a few injuries that kind of made me rethink the whole path. And I got into jiu-jitsu and I never looked back. And it was just such a humbling experience to put yourself in a position where you have no idea what you're doing.
Yeah.
It's really hard. And you really don't see any immediate success. And I hate to always attribute jiu-jitsu to other facets of life, but everybody today, I find, with social media and the reels and the pictures, it's all highlights. It's all, look at me, look at this awesome thing that I accomplished.
The instant gratification.
The instant gratification.
People want that right away, right?
Exactly. And I think martial arts as a whole, not just jiu-jitsu, it really teaches you that delayed gratification. And as a realtor, mortgage broker, entrepreneur, I mean, we know things don't come right away. I mean, there's a select few that hit it right away and they make it big and they make it look easy. Is it because they're as good as they are? I don't know. Is it luck? Who knows? But I think there's a lot of value in delayed gratification.
Totally.
Jiu-jitsu, martial arts, anything hard or anything that you're doing that you have no experience prior. I think it's great to get out there and really put yourself in those uncomfortable positions and just learn something new. So
yeah, it could be martial arts. It could be building a business. It could be, if any kind of, I say hobby, but skill, whether it's music or whatever. I think it's good, and I've learned that. I just turned 40 this year. And I think some of the real rewards in life are the things that that took a long time to really build. And I don't want to say master, but, just build and learn and grow, like my business and, martial arts and even finishing university degree. Right. So, just kind of you were asking about my path. So when I grew up in Yarmouth, I, from there, moved to the big city of Halifax.
The big smoke, yeah.
You know it, right? Yeah. Went to St. Mary's, took a business degree there. They're very well known for their business. Took a finance degree. Always had an interest in money. So it was good, and university, I always say this, it's not necessarily what you learn at university. I learned more in my first job working for CIBC in 1 year than I probably did in 4 years. But what it taught me is that, I can do this. It's a long-term goal. It's 4 years. That's a long time for 18-year-old.
Yeah,
you know what I mean?
100%.
And you can follow the rules. You can continue at it. You get knocked down. You get back up. So I think that's what university did for me. Is it showed me that I could follow the program. It's 4 years is a long time.
Overcome all the obstacles.
Yeah.
Because it's not like high school. They give you time to study for tests in between, and university, you could have 2 or 3 exams the same day or midterms. Or whatever.
Exactly, right. So from Yarmouth, I transitioned to Halifax, took my business degree at St. Mary's. Kind of, and then halfway through, you figure out your majored in finance. I just always loved money, whether it be investing, whether it be lending, different things. So I started working. My first job was at CIBC in Yarmouth, actually. So I moved home for about a year and a half.
And what position did you hold at CIBC?
So I was an account manager, small business, which was primarily dealing with small business owners, small business and commercial, though, because there was no commercial account manager in Yarmouth. It wasn't big enough.
You had to do it all.
Exactly. And it was awesome. It was really good because my parents were self-employed, so I could relate with a lot of my clients. And then I think I was always self-employed, like in high school. I don't know if it was kind of a hidden thing, but I used to burn CDs and sell them. Right?
Yeah. Back in the day,
Yeah.
some of the kids probably watching this, or the young folks, I should
Oh,
say,
yeah.
probably don't even know CD burners, man.
That's right. Yeah, it was like $1 a song. So if
Yeah.
I had 15 songs, you'd pay me $15, and you just give me. I'd be walking from class to class, and people would give these playlists. Yeah, have the songs, and eventually you already have the songs downloaded, so then you just put them on the CD, and you're making $15-$20, and it was a good spare.
Were you ripping them off Napster?
Napster, yeah, there was
remember?
Napster.
Yeah.
Oh yeah, Napster. There's a few though.
LimeWire,
yeah.
FrostWire,
yeah. That was just when we were getting out of dial-up and going to like a dedicated line.
Yeah, another thing people probably don't remember.
Exactly.
Some of the younger folks, like dial-up rotary phones, man, we're dating ourselves.
Exactly, yeah.
Remember when you used to leave the house and nobody know where you were?
What do you mean?
Right. Well, back when there's only landlines.
Oh, yeah,
As
exactly,
kids,
right?
You just look for the bikes in the driveway.
Yeah, you know what, though? I had a cell phone pretty young. I had a cell phone in grade 9.
Are you my age or are you a bit older?
I'm older. So like I said, I just turned 40.
Okay. Yeah, so you're a little bit ahead, but I still remember the days, like, of none.
Yeah. Well, I mean, I had to say, like, I remember grade 9, I had a cell phone. Felt like Zach Morris.
Right.
For I don't know if people remember Zach Morris from Saved by the Bell.
Yeah,
He was pretty cool. He had a cell phone.
Yeah.
It's this big
old thing.
Yeah, but anyways, the good old days. But dial-up internet, that was the thing. But anyway, sorry. So I sold burnt CDs. I used to wash cars. I used to have these Whose Line It Anyway shows at the high school. I did anything to make money. It was just
So you're always hustling.
Yeah, I loved money. It wasn't even the money. It was like what money could do. So I loved cars. I loved bikes, like bicycle, just different things that money could do. And that's kind of how I got into, I guess you could say, finance, into banking, and then how I got into mortgage brokering, right? Because when I started at CIBC, as a small business account manager, then I learned a little bit of everything. So you're doing personal finances for business owners. You're doing business banking for them as well, setting up accounts, setting up credit lines, credit cards, debit card machines, everything. So it's just, you learn a lot. And then, but I was really young. I was 22, 23, dealing with a lot of business owners.
How did you find, just to jump in, like how did you find people like portrayed you as a young banker at like the ripe age of like 22? Do you find like people still trusted you? Because I know younger folks that I've talked to that have gotten into real estate or different kind of commission based roles or like traditional bank facing roles. Sometimes when you're a bit younger, like people kind of don't give you as much credit that you kind of know what's up. Like, did you find there was any roadblocks there as a young banker?
Yes, to a certain degree, but maybe I think I was my own worst enemy, right? So
we all are.
Yeah, so maybe I was a little self-conscious that I'm 22, 23, 24, dealing with small business owners or even commercial.
Yeah, maybe twice your age.
That's right? A lot more life experience. So I just, as I kind of assessed, is this where I want to go? Do I want to, go deeper into commercial banking? Because, there's capital markets and there's different, higher end commercial account manager businesses roles that you can get into.
Right.
You can get into the investment route, because I did do my Canadian securities and wealth management essentials, and I was looking at doing my CFP, certified financial planning. Investing, is that what I want to get into? But same thing, people that are my age, 22, 23, 24, they really investing big amounts of money? Not really. But what people my age were doing was buying homes, right? And so I thought, you know what? So I kind of made a shift from that small business commercial banker role where I was doing a little bit of everything, kind of a jack of all trades, master at none. And then I wanted to, kind of specialize. So I became a mortgage specialist for TD Canada Trust, where I kind of got my stripes. Great learning programs. The banks have programs set up, the proper training stuff. You got sales managers and different things set up so that you can succeed. And so, I kind of shifted into becoming a mortgage specialist for TD. And then I kind of got poached after a year from TD to go to RBC, where I was for the next 4 years. But, kind of it stemmed back from when I was a kid and I loved cars and bikes and just different kind of things. I like to, even I was looking at your studio here and I love how you like customized it, right? I love when people, and people are doing this a lot now. They're buying homes and they're making it their own. I love that. You're showing me your home and you're saying, we're going to do this renovation. That's it. It excites me, right? So I love helping my clients buy a home, renovate a home, and really make it their castle where they feel comfortable.
Well, it is at the end of the day, whether it's a bungalow, a split, a 2-story, whatever, it is people's castles.
That's right.
So yeah, it's fun to make it your own. And that's a lot of the value that I would say I derive as well from being in real estate. And it's working with folks like you to help them create their vision and help them get the life that they envision for themselves. So
yeah, for sure. So it's been good. So yeah, I went from a mortgage specialist, then I went to be a rep for a company called First Canadian Title, which supports mortgage brokers. They prepare mortgage documentation for people who are switching or refinancing their mortgage. Did that role for about 4 years and met a lot of people in the industry. It was so fun. Basically, I would work with most of the banks, most of the mortgage brokers in promoting this service and how it can really help their business. And then, it made me miss the business. It's nice being, working business to business. And I think you did a role that was like that.
yeah.
But then it's also nice to be able to help the end user. And I really miss that, to be able to help your friend or your family or your friends or coworkers. Like I just love to really help those people. So about 4.5 years ago, got back into the mortgage industry as a mortgage broker. As a mortgage broker, we're a little bit more self-employed because we don't work for a company like TD or RBC or whatever. We're truly self-employed, right? We can design our own marketing, our own processes, our own just way we do things, right? We invest in our technology, our marketing, our I have an assistant, right? So it's nice. It's that I can build this business how I wanted, and it's kind of like I said, I grew up in a self-employed family, worked with self-employed people in the banks, and then now I'm one myself. So it was a good transition. It was good.
Yeah, that's awesome. I just kind of wanted to chat about a little bit of, my past upbringing, and wondering if it was if it was synonymous with any of yours. I did grow up as well, like Dad's, whether he wants to say it or not, always been an entrepreneur. He did work he's got his Red Seal electrician ticket. And at the same time, he was working fishing with Gramp, which Gramp owned the fishing outfit at the time. They often always work for themselves, were the master of their own schedules. But at our house and when I'd go to Gramp or in Nan's, they always wanted you to go to university, get a job. It was the gold standard was you got to go to university, get a job with a salary and a pension and benefits. You don't want to do what we're doing. Working with your hands, it's no good. You got to find something better for yourself. Meanwhile, I'm looking at them like they're the kings of their universe.
Yeah.
And I'm like, well, why wouldn't I want to do that? And why do I have to go do these things that you guys never did? So it was always portrayed that like what they were doing wasn't good enough. But I mean, we never hurt. Like we weren't the wealthiest. We weren't, probably upper middle maybe. So it was always struck me kind of oddly, especially sitting in the chair today, looking back as to like, why was it such a big push? And I often wonder, was it the same at everybody else's house? And I wonder why that is.
It was definitely the same in my house. And I think for my family, was my parents wanted for me what they couldn't have.
Right.
My dad was self-employed, not because he wanted to, because he had to.
Right.
Right. Like I said, barely spoke the English. Like his English is good now, but when he first landed here, his English wasn't the best. He didn't have the education. He just didn't have the connection. So he had just no choice but to start his own business. And so maybe our parents are trying to live vicariously through us
Potentially.
and say like, hey, like my dad always wanted me to be a branch manager, and I was a branch manager with TD for a short stint. I can't say I loved it. It was a fun job to oversee a branch and hire people and be responsible and set up schedules and do different things, but it just it still wasn't running my own business. But my dad always wanted that. He just it was a position of kind of power or whatnot, but stability, as you could say. But I know your past, Chris, and you had a great job and whatnot, and then some things changed, I think, around COVID or whatnot, and they let you go. So you can't necessarily, that can't happen in your own business. It can, but not really, right? So I think our parents think that there's security there. Not to say that there isn't, but they want security for their kids, great. But they also just, I think, want what maybe they didn't have.
Yeah, I think that's probably spot on. And just to allude, and I probably went over it in a few other episodes, but yeah, I was the district guy for Unilever Canada, a big tier 1 consumer packaged goods company. Highly sought after, like one of the most sought after companies to work for after Google and Apple. And like you, really enjoyed it. Can't say I really loved it. I loved the people I work with. I loved the challenges, although they come, with experience, it becomes less and less challenging. And, for me, looking back, I always wanted to run my own business because I watched Grandpa and Dad do it, and they were good at it, and they were well respected in the community. So when I unfortunately got restructured out of the business, non-performance related, it gave me the opportunity to kind of jump in and do what I was originally interested in doing, but was very kind of put off and kind of scared away from it. Just not being mature enough to make that decision, and obviously kind of listening to that feedback from my parents and grandparents saying like, well, you need to do this, and real estate entrepreneurship wasn't necessarily what I was being told. So yeah, it's, it's tough, but, you jump in and you make the best of it. And, here we are today. So
yeah, maybe I relate it to some of my hobbies like martial arts, or got into riding motorcycles now. It's been a while, but I went skydiving before, and it's been a while, but I've gone skiing before, and there's a bit of a rush in it. Right?
Yeah.
So would you say there's a correlation with, that rush that you get from, say, jiu-jitsu or running a ultra marathon, 50 kilometers, which is crazy, absolutely crazy. But anyways, there's a rush with that. There's also a rush with, running your own business, and, when you're showing homes and it's a hot one, you got to act quick, and there's a bit of a rush to it, right? And you only live once,
100%,
and you want to make sure you're getting out there, you're making the most of what you're doing, like even this podcast that you're doing, and like I said, your jiu-jitsu and run your ultra marathons, like you will never look back at that and say, why the heck did I do that?
No, man, you're right. And the thing for me too, unlike some other folks, and not to say that everybody just wants to take easy street, but I was never into anything that was too easy.
Sure.
Like I always wanted to do hard things. I kind of make the joke to my wife, I just want to be ready for anything.
Yeah.
Like, and if it's too easy, like I'm not interested. And if it's not challenging, like I lose interest fairly quickly.
Yeah.
So for me, all the endeavors that I've taken on were things that I originally didn't think I was capable of doing, but it's amazing what you can accomplish when you just kind of buckle in and kind of lean into this scary thing that you're trying to accomplish, whether it's martial arts, whether it's starting a podcast, which I was never a big social media guy. So it was a huge jump to kind of get this going. Real estate, the same thing. But to your point, every positive comment on the podcast, it's like, it makes it that much easier to do.
Yeah.
And, every extra kilometer you run, you'd be surprised at how far that'll take you once you kind of compile that volume and kind of try to do your best. And same thing with weightlifting, powerlifting, bodybuilding, like, it's all mindset. So, I always say to people, there's two types of people in the world. There's people that believe that they can, and then people that believe that they can't.
True.
And they're both right.
Yeah.
You just got to decide which one you are.
Exactly.
So I've always leaned into hard stuff. I like doing hard things. I like overcoming challenges and being as successful as I can be.
Yeah.
You know, often people are, have told me or mentioned to me before in the past, it's like, why do you feel like you got to be the best at everything? And it's like, well, I'm not really necessarily trying to be the best, but if I can be the best that I can be,
Yeah.
then
Be my best.
my best.
You know what I mean?
My
And
best.
I've kind of shifted to that because it's easy to get competitive with everybody out there, and some people have, advantages and whatnot.
Yeah, well,
But
comparison's the thief of joy too. Right?
Sure, right. But I've kind of shifted things and just that personal best.
Yeah,
right?
man.
Just try to up what I can do, stay in my lane, and it's good to get motivated to other people when you see people that can, run more longer distances than you or do this or lift more than you. Then that's motivating to know that it's possible. But then really, try to compete against yourself is what I try to do.
100%, man. 100%. So let's dive into a little bit of the nitty gritty here. I know we just had a big announcement yesterday. We had a 25 bip decrease. The Bank of Canada announced that they were going to reduce the rate by 25 bips. How do you feel about that? What's your overall kind of consensus on the direction that they're taking? I know there's a few mixed messages out there. I know I've seen somebody from our office share a post that another fellow from Ontario posted saying that, hey, everybody's so excited that we got this 25 bip decrease, but like, look at this graph. Generally, decreases in mortgage rates kind of indicate recessionary periods. And I spoke with a few of my commercial banking friends, financial analysts, and I actually sent them the video, and I got some feedback, which I'm going to make a reel on a little bit later.
Yeah.
But they essentially say that the graph that they're alluding to is right in the sense of when that was charted, but they're wrong in the sense that, mortgage rate decreases don't necessarily indicate a recessionary period at this point, given our economy, our job market. It's all doing fairly well. I wouldn't say strong.
Yeah.
And then typically we use rate decreases to stimulate the economy in recessionary periods or expected recessionary periods, for example, like COVID.
Yeah.
So they're not wrong, but they're not right for sure.
Right.
So can you comment on the direction on where you think this is going to take us?
Yeah. So reducing the rates to stimulate the economy is one of the reasons to reduce the rates. It might not necessarily be the case here, especially, in the housing market, but even the consumer goods and stuff like that. I think people are still buying cars. People are still buying homes. They're not buying fancy homes, but they're still buying homes.
We need homes.
Yeah, right. This is kind of generally speaking, in my opinion. They're reducing rates because they want a soft landing from the low rates that were had 5 years ago. So to remind people, rates were like a 5-year fixed rate was in around the mid 3% pre-COVID, right? And then when COVID happened,
people forgot that though.
They did.
They think it's going to go back to 2021.
Right.
But anyway, continue.
So when COVID happened, the sky was falling and nobody was spending money and stuff like that. Understandably, there was something that.
Well, we were told to stay in our homes.
Yeah, and when you saw like empty streets of, downtowns and
it was very eerie.
New York and Vegas, where it was just completely empty. It was eerie. So the government did what they had to do, and they dropped rates to stimulate the economy. But anyway, so rates went from like a mid 3 to like a low 2%, high 1%, like 1.69 to 1.89.
We got 1.87. I think we were new.
There you go.
Yeah.
Right. That's crazy. So
it is crazy.
So that would have been like 2020, 2021 type of thing. And those mortgages, because those rates were for 5 years, those mortgages are coming up for renewal. And when I say those, there's a lot of them.
How much?
I don't know the number, but I've heard some different numbers out there. But there's the people that bought, but there's also people that refinanced, right? Because they just didn't know what was going on, and the rates were so low. So why not refinance, pay off some debts, keep things just very manageable because the sky's falling, right? So those mortgages are coming up for renewal in 2025, which is just around the corner, and 2026. So what we'll say the government, the Bank of Canada, and the banks want to do is have a soft landing. They don't expect people to renew from a 1.89 to a 1.89. But if they're going to go from a 1.89 to, where rates are right now, low fives, high fours, that's a big jump. Like a 3% swing or more would cause a lot of, possibly delinquencies, a lot of, which like foreclosures and late payments and just different things, right? It'll hurt people's spending. Different things could happen. So they want a soft landing. So what's a soft landing? It's hard to say. Maybe like you're renewing like 1 to 2% higher instead of 3%, right? Like right now, people are kind of renewing around a 1.5% higher, going from a mid threes to a high fours, low fives, right? Mm-hmm. So they're going to feel that pain, but they're not going to feel that pain. So I think that's, in my opinion, the main reason why we're seeing the rates starting to come down, because, now we can see when we know that those low rates from mid 2020 are coming up. So why not do that in advance instead of just waiting till that date and dropping them really abruptly, because that will speed up things too quickly. And, house prices, as you know, are fairly high, generally speaking.
578, I think.
What's that?
The average for a home in HRM.
I thought it was 5.25. But so there you go.
Just had a monthly update there come through, and the numbers Remax had was like the average sale price in HRM is like so 578,000.
So there you go, right? Like I'm meeting with clients that have a modest income or a decent income, in my opinion, and they can't qualify for very much. For me to tell them that they qualify for a home for $350 and they tell me there's nothing there, it's tough, right? Yeah. So yeah, the government and the banks, and the lenders, they have to be very cautious with how quickly or not quickly that they drop the rates, because we don't really want house prices to go up too much. Yeah. I honestly want people to be able to own a home, right? And sure, we're paid on commission, so the higher the price of the home or the higher the mortgage, the more we get paid. That's not my thing. I want more people to own homes. People, yeah. And you know what? Obviously, because we can do more mortgages, we can help more people buy homes if they stay modest, right?
100%.
But anyway, but going back to what you were saying, it's kind of stuck in my mind. You said, the big announcement. So the 0.25% drop is not a big change. That's a pretty standard. What was so big about it is the Bank of Canada was saying, okay, we know we have to drop rates, and we will drop rates, but they weren't really being clear on when they were going to drop rates, because they were always saying like a year or even 2 years ago, they said, mid 2024 we'll start dropping rates, but then they kind of threw out some stuff at the beginning of the year. They said it might be April, so everybody, including myself, got our hopes up, and then April came around, they said no, we're not going to do it, and then when June came around, we started to hear that there's a 50-50 chance that they'll drop it in June, but they might push it till July. And I'm like, oh, here we go again, right? So, right now, I think there's not a lot of faith in the government, generally speaking. Don't get me wrong. I'm not a government hater or whatever, but a lot of people are, kind of frustrated. You had kind of mentioned recession and stuff. I think we're in a bit of a one, to be honest, right? Like gas prices are really high. Groceries are really high. Like maybe it's because I'm old, but, I'm at dinner parties and we're talking about the price of gas and groceries, like, even me and you, right?
Yeah.
And maybe that's part of adulting, but I think it is. It is, but it's in the news. It's in it's everywhere. So things are really high right now. And we do need the help of the government, in my opinion, right? And then, when they're not being clear on what they're going to do, and they're, we're not seeing much spending because there's no election yet, right? And, we're seeing carbon taxes and stuff like that, and rates are staying high. It's kind of like, I think people can lose faith in the government. So it's nice to see that they actually dropped the rate in June, because they were toying with not. And I think that's what made it a big announcement. Not the amount that it went down. It's just that it's the start, and they actually did something that they said they were going to do, which... Yeah. Does that make sense? Do you get where I'm going?
Yeah, 100%. I mean, and prior to yesterday, we had eight increases.
Right.
So, I mean, just that alone, it's like, people are expecting to, in the past to just keep going up. And then we had a few holds, and now we're on the way back down.
Yeah.
Another question is like, if you can answer it, I'm not sure that you can, but I know obviously our folks down south from us, the US, we're always kind of looking at them,
Yeah.
you know, and kind of benchmarking off them and their performance and how they're doing. And correct me if I'm wrong, but I'm pretty sure, you know, the US held their rate.
Yeah.
Which kind of caused some hesitancy potentially on our end, and some, you know, people are thinking, well, maybe we're just going to get another hold as well. Can you comment as to why we kind of took a different direction than the States? Do you get any visibility on why they're doing what they're doing when you talk with your folks at the office? Or?
Yeah. I'll be honest, I don't follow the United States as much as I probably should, because our industry is very correlated with the U.S. You know, we're neighbors. We do a lot of imports and exports. But yeah, so the U.S. is a little bit different. They've got, you know, I think their elections will be sooner than ours. I think their economy, generally speaking, mind you, is doing a bit better than ours. But they have their reasons, right? And also, the banking system and the mortgage system in the States is different than here. You know, we have terms that are coming up for renewal, like 5-year terms. To my knowledge, in the States, they don't really have that. Like when you get a rate, it's for the whole life of the mortgage.
It's for the full.
Yeah.
Okay.
And again, don't quote me on that, but I know it's different in the States. And so they might not have all these renewals that we have.
Right.
So there's just, it's hard to compare. As much as there's similarities with the U.S. and Canada, it's hard to compare the two countries. Right. But one thing that I've heard is that because we dropped the rate and the United States did not, it hurt our dollar. Right. So we've also got to keep that in mind, because there's so many things that, I mean, and again, maybe as I get older, I'm starting to pay attention to these things, or because it's more of a topic, is that there's just so many things that contribute to the economy, like the exchange rate, gas prices, inflation, GDP, that go into this, right? The Bank of Canada, I feel like they're a bit of a one-trick pony, and they just have really the rate that they can control. I'm sure there's other things, but it's just the thing. So I'm glad that they dropped 0.25% when they did. I think if they waited till July, I think it would just lose a lot of faith in the people.
Yeah, I hear you. And then a lot of people, you know, they see this rate announcement, the 25 bip decrease. Obviously, the overnight lending rate directly influences the variable rate.
Yeah.
So the variable rate mortgage folks are going to see some immediate relief by that percentage. Can you speak to, you know, for those that don't understand how mortgages and the different levers that pull on the different kind of products that we use for lending, can you speak to, you know, the fixed rate, and do we foresee the bonds market and the fixed rate trickling down as we see these variable rate decreases? Like, is there going to be a correlation there? What do you think is going to be happening for fixed term mortgage folks?
Yeah, good question. So you're absolutely right. It's like the overnight rate really reduced the bank prime, which was generally speaking 7.2%. So that went from 7.2 to 6.95. So anybody with a variable rate mortgage, not just variable rate mortgages, but like a lot of lines of credits are based on prime.
Yeah.
Like we'll see like prime plus 2, for example.
Yeah.
So if it's 7.2, then your rate on your line of credit might be like 9.2, right? So those people would see a reduction in their rates and so on. So the fixed rates, to your point, is more linked to, say, the bond markets. And the bond markets, what they try to do is they try to forecast out, right?
Out.
They're looking, 5 years out, 4 years out, 3 years out. Where do we see rates going? And they already saw that rates were going to come down around mid this year. And we actually saw fixed rates drop this year.
Yeah, before variable.
That's right. Mm-hmm. And they will, because they're kind of a leading indicator, because, again, the bond markets are trying to forecast out. It's funny, though, because it's not as much of a hot topic. Do you see what I'm saying? Like the overnight rate and the Bank of Canada and what they're going to do was such a hot topic that this 0.25% drop had a bigger effect than fixed rates. There was a point in time, I think it was around like the end of last year, October, November, that fixed rates were like a 5-year fixed rate was like 5.84%. And then, fast forward to today, we're about 1% lower. We're like a high 4s, low 5s. And not much news on that. Do you know
Not
what I mean?
much, yeah.
That it just didn't spark the media as much. We saw the rates go down, bankers saw the rates go down. We communicate to our clients, but it's kind of like people didn't care as much,
Right.
right? Until this announcement, and then I get clients that reach out, and they're like, "What does that mean to rates?" And I was like, "Well, the fixed rates didn't really change much. We had a few lenders that came down 0.1%, so not a whole 0.25%. But we saw some go from like a 4.99 for a 5-year fix to a 4.89. We saw a mild drop because again, they're still forecasting out what rates are going to do in 3, 4, 5 years or so on. But it just didn't have the direct effect that I think the average consumer thought it would.
Right.
Yeah, yeah.
So like what would you say has to happen for like the fixed rates to come down, a little bit more, like, for people that, oh, the bond market kind of dictates the fix. Like, can you elaborate for people that maybe don't know much about, the different financial kind of products and things out there? Like, what is the bond market? Like, can you kind of speak to that for those that don't know? And like, what would be some kind of levers that kind of pull on that or affect that? And
Yeah, there's a lot of different things, right? The economists, when they're trying to figure out the price of bonds, obviously it's a form of investment. People will invest in bonds, and that money gets, lent back out in mortgages and such. But they're going to look at things like inflation. They're going to look at things like GDP and the CPI, and they're just going to look at the economy as a whole. Again, the overnight rate and where that's heading, right? So what's got to happen before we see fixed rates drop? Like I said, there's a correlation with the overnight rate and the bond markets, as we said, right?
so they do pull on each other a
They
little
do.
bit.
Yeah, there's definitely a correlation. Obviously, like a lag, like we said, the fixed rates came down before the variable rates, and so we one of the things, just to stay on topic, is the variable rates or the overnight rate has to continue to drop, essentially, right? And what we're hearing a lot of, at first we started to hear that in 2024 the overnight rate would go down 1%, and it could. Some bank economists still think it'll go down 1%, but I think the majority, from what I'm seeing, it thinks that the overnight rate's going to go down about 3/4 percents, right? So it already came down 1/4%, so maybe 2 more. There's 4 more rate reviews this year. In my opinion or guess, kind of, I think they'll skip the next one, as in not change the rate, decrease the rate in July. And then the next one, I think, is September. I think they'll drop it then. And then the next one's, I think, November. I think they won't drop it then. And then I think in December, they will drop it to kind of end the year on a good note. 3/4% drops. That's just my guess.
So kind of staggered.
Yeah. Because, and I've been watching, the Bank of Canada, their announcements, and they said, we want to do this gradually. If they do 2 drops in a row, in my opinion, that's not gradually,
And
right?
that could stem some inflation.
That's right. So they want to bring this rate down with a soft landing, which they've used those words. So soft landing is staggering it, kind of, and that's my guess, but that's my, I guess, educated guess. And then they're saying quite possibly a full percentage drop in 2025.
Okay.
Right. So that's, how they do it. It's probably 4/4% again. It's rare that they do more than that. And they can pick from, how many rate reviews is there? I think 10. It's not every month. It's like every 5 weeks or so.
Yeah.
So if there's 10 and they have to pick 4 to drop, then again, that's gradual, right? It'll probably be in the beginning of the year, I would say, to kind of, so that those renewals can catch it, and then they'll probably chill for a little bit in the rest of the year.
Mm-hmm.
But again, they got to be very cautious, because if they drop it too quick, prices of homes go up, inflation goes up, and all this stuff.
Yeah, and just to kind of add to that, I guess, so you kind of brushed up against it, and I know people are kind of wondering, like, okay, so we're thinking maybe it's going to be more of a staggered strategy, so we might get a hold next one, maybe another 25 bips. What has to happen in your mind to continue with the nice kind of slow, soft landing kind of decreases? What has to happen for that to continue? And then on the flip side is like, what could kind of stem that and kind of put a hold on the decreases overall? Like what would be happening out in the atmosphere, yeah, in the out
out
in
in
the
the
world.
world. Yeah, out in the world. Well, there's a lot of things that the government, the Bank of Canada, and the banks are going to look at. They're going to look at inflation. That's
Right.
been a big thing.
And we're what, around, I think last number I seen like 2.7%, and target's
Yeah,
always between 2-3%.
that's
like where
right.
we
They want
want
to get it
be.
down to about 2, right?
Yeah.
Because inflation has been a real thing. Like,
Yeah.
like I said earlier, is the cost of groceries, the cost of gas, the
Yeah.
cost of goods and services
And
has
that's
just
all
gone up.
measured through the CPI index.
Yeah.
And for the people that don't know, it's a consumer
Price index. Yeah. Yeah.
Which would be kind of like they look at kind of the basket of goods people are buying and like how big is that
Their essential
basket?
goods,
How many
yeah.
goods are in the basket? What's the price per good? So on and so forth.
You're bang on,
Yeah.
right? Economics 101.
Right?
Yeah,
I was a shitty economics student too.
Yeah?
I think if I went back to school, I could do it even better.
100%.
Because I have such a better understanding of
I
like
agree.
being out in the world.
I agree. And that's why I said, not to knock university or anything, but that's why I said, like, I learned more in my first year of work than I probably did in the 4
Yeah.
years. It's when you're 18 to 22. That's, when I was in school, like, you just don't have enough life experience to translate all these things. But anyways, going back to what you were saying, so they're going to look at inflation. They want to get that down because things were just like, and in defense of the government, if you could say, COVID was a weird thing.
It was a weird thing, yeah.
And that would be a tough thing to combat. And so, yeah, it's funny because, if you think back, it wasn't that long ago, but when COVID happened, people stayed home. So they didn't travel as much. They didn't drive as much. They didn't eat out as much. They didn't spend money at stores and vacations and all that. So people kind of sat on some money. Gas prices were low and everything like that. And then when things opened up, people just went kind of crazy.
They went crazy.
You know what I mean? It's so funny. And then they went so crazy. They're buying cars and going on vacations, buying homes, spending like $150,000 over list price. It's just crazy because you saved a bit of money for 6 to 18 months. Anyways, it is what it is, and I get it, right? Because we were like caged in a sense. But anyways,
Yeah.
so inflation is a tough thing to slow down. It really is. And so, in defense of the government, that might sound like I complain about them a lot, but it's not an easy thing to slow down the economy and not slow down the economy, but slow down inflation, right? So that's one of the things that's going to affect, that they're going to keep an eye on before they start dropping rates. But the other thing too that, people don't always talk about is elections too. Right. I'm not a conspiracy theorist and stuff, but there's no coincidence that when there's an election, you start to see rates drop. You start to see
Well, you're getting
spending.
into my next question. Yeah.
Yeah, you start to see spending. You start to see rule changes, right?
And we're seeing it here.
Yeah.
We had height restrictions on buildings. Only could build stuff here, not there.
Mm-hmm.
Now they're realizing, I think, and it's kind of leading into my next kind of topic was like, we're talking broad spectrum here in terms of like the Canadian market and mortgages. We live in Halifax.
Yeah.
I know we're behind like 30,000 starts for new construction. I think it's roughly the last number I heard. Obviously with rates going down, that does, kind of elude more buyer confidence in, the real estate market. It could also impact the buyer pool, which I would expect we're going to see a little bump in people getting back into the market and trying to get homes. And I guess my worry is like our supply is so low, like we're just over 1,000 units on market, which is kind of the highest it's been in a little bit.
Yeah.
Just over 4 months of inventory. So if like we stop listing homes as realtors in 4 months, we'd have no homes on the market.
Yeah.
So for me, I always I worry. Obviously the rate decreases are good.
Yeah.
But with our inventory supply being so low and our surplus of buyers and immigration and people coming into Nova Scotia or Halifax, I just worry that we're going to get back to that, like not quite 2021 crazy, but my fear is that it might pop off a little bit too much if we do it too quick. Like,
yeah, I agree and I disagree, but I do agree.
Yeah.
It's
why don't you tell me where do you agree and where do you disagree?
Yeah. So it's hard to compare Halifax to every community in the country. You know what I mean?
You're right.
So if you start listening out there, and I don't know the stats, but I think, Toronto and Vancouver are slowing down a little bit, whereas Halifax still going up. I get scared that Halifax will become a Vancouver, if you will,
Right.
where an average person can't buy an average home. That scares me.
Well,
We talked about that earlier on, right? But yeah, you can't really compare our community like HRM to the rest of the communities out there, and there might be like, I think Moncton's doing pretty well and stuff like that.
Fredericton too, I think.
Right. Like the cities, the small cities are doing well because I think generally speaking, I'm just saying general speaking, people that are immigrating to Canada or immigrating to other communities, they want like the amenities that the cities can offer. Whereas when you then look at, towns like where we're from, it's not as booming as much. Right.
Because you have to want to be in those areas.
You do, right?
It's a select demographic.
That's right. We're post-COVID now. During COVID, people thought it was just great because we needed all this space and we could work from home and stuff. And then,
right. Move anywhere, live anywhere.
That's right. Right. And we saw some reversals. Like I don't have a good pulse on the market in Yarmouth or even some small towns and stuff, but I have heard of some reversals, if you know what I mean.
Yeah. And have you also heard some of like the, our doctors that we're trying to get in here and health professionals and stuff? I've heard a little bit like they don't have what they were told they were going to have here.
So they've gone back.
Yeah. And obviously we're always screaming for doctors and pharmacists and therapists. And, I just worry that if, we can't keep up with the services and things that people need, that, that we'd have like a mass exit. I don't know if mass exodus is the right word, but, we sold people on why they should come here. And then I think people have showed up and they're like, well, you're lacking quite a bit in X, Y, and Z departments.
Yeah.
We left a place that had all these things. Yeah, it was maybe more expensive, but we're maybe better taken care of.
Yeah.
So maybe we want to go back there.
Yeah, I think there's definitely some reversal. But I'm talking about HRM now. I think we have more people coming here than we have leaving.
Yeah.
There's I like Halifax, I really do, and we've got some good growth. But to your point, there's not enough inventory here. We're seeing a lot of builds. I want to see some of the smaller communities start to grow up. You know what I mean?
Yeah.
And
we're booming here in Sackville. Man.
No doubt, Sackville.
There's like 7 or 8 apartment buildings going up.
Yeah. Yeah, Sackville's great. Enfield, Elmsdale.
Oh,
booming.
Yeah. I've sold quite a few people in there.
That's right.
Got clients we were up looking out that way Wednesday.
Yeah, new construction and resale.
Yeah.
Right. I mean, I'll say like Timberley, Hubley, Tantallon, but those markets already blew up, years ago. But you're starting to see things push out. And we're becoming a bit of a mini GTA, if you will, which is fine. Like my sister lives in London, Ontario, and that city has boomed because it's just outside of the GTA and it's affordable, right? It's kind of like maybe the Elmsdale of Toronto, right?
Yeah.
So I think we're going to start seeing that, but the thing is it can't happen fast enough here. I think the people obviously are just coming to Halifax faster than they can build homes and come up with supply. But I'm starting to see a lot more people. Like I've heard of just 2 people in the last month or so that are moving to Florida or moving to the States and stuff like that.
I've heard there's a lot of Canadians moving to the U.S.
Right. Yeah. So we just got to be careful of that. And but I think generally speaking, there's more people coming here than leaving.
Definitely.
But yeah, hopefully we can find some more supplies on homes, like whether it be more backyard suites or rental properties, other people's homes, whether it be quicker development of individual homes or large apartment buildings. We need some homes, no doubt.
Yeah, and that's just to jump on the backyard suite thing. I've heard a lot, and working with clients, it's come up a lot. A lot of people are looking for a nanny suite in the home or a backyard suite, and I've heard a few scenarios where, like, let's be real, like if you and your partner or even yourself, lived in Halifax, made like, $100,000 a year, we know that the rough math, I think, and you correct me if I'm wrong because you're the mortgage guy, but I was always told, if you want a rough idea what you can afford to buy a home, you take your salary, kind of times it by a 4 multiplier.
Yeah.
And that's roughly what you can afford
on a mortgage.
Mortgage.
You got it, right. And you're not wrong. Like there's exceptions to the rule.
Yeah.
Okay. So if you have a bunch of debt,
yeah,
it's going to reduce
max
that 4
credit
times.
Card, yeah.
If if you had like car loans, student loans,
Yeah.
credit card balances, line of credit balances, the amount you put for a down payment. So the bigger down payment you have, not only increases the price, but it increases the mortgage as well. So, as a mortgage broker, we have access to alternative lenders. So we can do what's called extended ratios. So it basically means lend you a little bit more than the traditional lenders will do, like the 4 times. So maybe might be 6 times, for example. Right?
Okay.
We can push the buyer a little bit more because you have so much skin in the game. You have so much more of a down payment, right?
Yeah.
So that's one of the reasons why I love being a mortgage broker, is we just have access to more products, right? And it's not for everybody. I don't want to overextend people, but there's also certain situations like we're seeing a lot, and I'm sure you're seeing this, is that jobs are different now. So I say rare, but there's not just salary now. I'm seeing bonuses. I'm seeing overtime. I'm seeing shift premiums. I'm seeing
side hustles.
I was just gonna say that multiple jobs, and so a lot of the lenders they have a 2-year average,
Right, and that'll bring you down.
Yeah, we're seeing a lot of people work 2 jobs, and they're like, "Oh, this is how much I make," and it's like, "Yes, how long you been doing it for? 6 months. I can't. You got to show me that you're doing that 2 years."
Because for the viewers too, side hustles and like casual employment doesn't really, until you get your 2 years on your side hustle, and then if you're working casually on another thing, like you can't really use that casual work.
That's right.
When you're getting financing for a mortgage.
Yeah, and sometimes, we say 2 years. Sometimes it's even 3 years, because if
Right.
you started that side hustle halfway through a year, so
You can't count that full
that's
year
right.
when you started halfway through.
That's right,
So
right?
you got to
So
do the full consecutive.
if you wanted the true value, right?
Yeah.
Like if your side hustle's, I don't know, $20,000, but in year 1 you have 10,000, and then because it was partway through the year, right? So though I say 2-year average, it could almost be 3 before it really truly reflects.
Yeah.
I don't blame the banks and the lenders for having that, because if you qualified for 500,000, you're like, oh, I need to get that to 600,000-700,000. I'm just gonna go get a part-time job and get that for 3 months, and all of a sudden I get you more. But then you're like, oh man, this is tiring. I'm burnt out.
Right.
And
you quit.
You quit. You do that after 6-8 months. Well, geez, now we've lent you a home that's not realistic on what you can do for an income.
And now you're in a bit of hot water.
Yeah. So it's a 2-year rule. I don't disagree with it. A lot of my clients do. A lot of my clients try. No, that's not the rules. I'm just like, who's doing this job, right?
Right.
Yeah,
I know.
But sorry, what was the question again? I think we're getting a little sidetracked.
No, I was just kind of making a, how would I say, losing my train of thought here. An observation out in the market right now. I find there's a demand. They obviously made an announcement that they'd give you $40,000 for part of it's forgivable if you wanted to do a nanny suite or a backyard suite.
Yes.
If you wanted to rent it, to make some more affordable rental options, the stipulation on that loan is that you can only rent to 80% of market value.
Right.
So what I've been finding, and then what I alluded to, is like, say you're a couple that each make $100,000 a year, it's 200.
Yeah.
Even some of those people, depending on what they're looking for, or I guess 2 people are probably more realistic, because times 4, that's a bigger number.
Yeah.
But say you're one person making $100,000, you're only qualified for say 4. That's if you don't have a credit card balance and a luxury car payment, because we know that there's a significant downshift. If you have those types of liabilities in terms of what you get lent. So what we're seeing and hearing now that's becoming more common is like the parents are kind of being like, okay, well, listen, we're kind of at the end of our work cycle where maybe they're already retired or getting ready to retire, and they got the family home that they got a ton of equity in.
Yeah.
They're like, well, listen, we don't really need this big home.
Yeah.
Why don't we sell it? We'll help you with the down payment to get the new one. And then let's build a nanny suite, either attached or a backyard suite. You guys can have the main house. We'll just chill in the suite.
Yeah.
And then basically kind of help them kind of afford what they need. And that, from what I've been seeing, is becoming more and more commonplace to kind of combat some of that like housing affordability.
Yeah.
So more often than not, I've had, people asking me about backyard suites, if there's nanny suites, or they're looking for something where maybe they could live in the main part, rent the other, kind of like what I'm doing here.
Yeah.
Converted my garage into a nanny suite. This was before
before it was cool.
The newest announcement, but we took advantage when they said, well, all R1 zone properties can apply, and then if you get accepted, then you can put a backyard or nanny suite as per X stipulation dimensions per the city. So yeah, seeing a lot of a bit of a shift in how people are getting creative in getting either their kids homes and or just, you know, making it more affordable to be in a home, whether they're renting to family or just, you know, they're starting their investment journey. So I guess it's kind of cool in a sense that, you know, people are getting creative, but it's also a little disheartening, I guess, when I look back at, you know, when I was with Unilever, I was making, you know, a good income. My wife was, you know, she does way better now. She's with forensics at HRP. So I just look back at where we were when we started, and I thought we were going to be house poor, you know, and that was, you know, 10 years ago, we bought this place for $212,000. You know, we were well within our means. Like the bank approved us for like $450, and I was like, man, are you guys crazy?
I'd never spend that much.
If I bought a $450,000 house when I was 20 whatever years old, I was like, man, the only place you'd find me would be in the house. I couldn't afford to do anything else.
I know.
But now everybody's like pushed. You want a house? What's your max budget?
I know.
You got to be so close to that max.
Yeah, and I don't like taking people to their max. I don't.
I always try and get people to not, but then some people are adamant that that's the number and we're going for it.
Yeah, I know, right? And just going to their limits.
Yeah.
And
what do you think about this? Sorry to jump in.
Yeah, no,
just before I lose my train of thought.
Go for it.
You know, ADHD.
Yeah, man.
When I first started buying, or when we first started looking to buy our first home, obviously affordability and not being house poor and making a sound decision financially on how much we were going to spend and where we were going to buy. I talked to my buddy, Kevin Ryan, really good buddy of mine. He was the national key account manager for the Loblaws ice cream business. And we still go to lunch every other month or a quarter. And, you know, I got, you know, people in those industries I really like, and we keep in touch. And he kind of shared with me when we were kind of getting in the game, trying to look for a home. He's like, listen, he's like, man, he's like, if you find something, but it's a bit of a reach, he's like, you know, you're young, you're going to kind of grow into your career and your salary will increase, you know, as you progress. So like, even though it's tight, if you think you can make it work and it really is this place, just go for it. So and that's what him and his wife did. Yeah. They kind of reached a bit, and it was tight for a few years, but they had what they wanted and they knew what they wanted and they had a plan, and they kind of just like grew into it. Yeah. Whereas we took kind of the other strategy, because my wife's very, very frugal. I'm more go, and she's more
conservative.
She's got the reins on me. Like, hey, settle
you
down,
need
cowboy, right?
You need that yin and yang.
Because otherwise, I just run through whatever wall and try and make it work. Not to say that that's the right way, but she's taught me a lot in terms of patience and you know, frugality, and you know, not that I'm the worst. I don't spend it all, but you know, I like things.
You're a risk taker.
Yeah,
you're a risk taker,
yeah,
right?
Exactly. And I grew up with risk takers, right?
Yeah.
You know, maybe Dad doesn't think that, or Gramp or whatever, and maybe that's why they wanted us to go to university, because they did see the risk involved in what they were doing. But it's just cool to see different ways of getting into it, but it is a little disheartening that, you know, we got in the market when we did, and then I have people my age that, you know, just didn't go down the same path, and, you know, rent was so cheap that it made more sense. And now some of these folks are trying to get into homes, and they're making decent incomes, and they just can't, you know.
Yeah, a few things to say about that. Like, about your most recent thing is that incomes are lagging, like, the inflation.
Yeah,
like
you look
the cost
at the graph.
Of things. The cost of things are going up so quick. Incomes are going up, but it's a slower.
It'll never catch up.
Never say
never. Not never,
right?
But like
it takes a while, right?
Because to the rate of increase that we've seen.
Well, that's just it.
That's a big spike in cost of living, housing prices.
Yeah, employers are smart, right? So they're not going to just jack up incomes if they don't have to.
Where are they going to make it up?
That's right.
They got to sell more product.
Yeah. Meanwhile, the cost of goods and services can go up. Like there's less control on that. So I do see a little bit of a lag. I think I do see salaries going up, which is good, but it's slow. I think what's propping up kind of the high prices is those who are selling homes that have a lot of equity in it. They're taking that and then they're putting it in the next, and that's how they're getting to 600,000-700,000, which they never thought they would, but because they had 200,000-300,000 of equity on their first home that they bought. But going back to your buddy there, I would agree with him to a certain degree of, if you're young, maybe stretch it a little bit more within reason, right? Because a few things, right? Younger people might have might be lower on their salary, and they're going to see income increases. If they have any debts like car loans, student loans, or consumer debt or whatever, some of those, well, a lot of those won't be there forever, right? We have to assume that if you have a car loan and it's $700 a month, we have to assume that you have that for the whole life of the mortgage. But, you know, if you can pay that off and go car loan free for so many years, then, you know, that's going to help. And then there's also, like I said, with incomes, there's a lot of variable incomes, bonuses, overtime, raises, obviously, that we just can't factor into the calculation. So for younger clients, I look at the profile, you know, are they risk takers or not? Is there income that I'm not included? Is there debts that they're going to pay off? And then, you know, if they want to go a little closer to the max, okay, I get it, right? I think what the government should do, and they've kind of started, they're dipping their toe in it, is I think they should let first-time home buyers do 30-year mortgages.
30 years.
Yeah, like you can do a 30-year mortgage if you're putting 20% or more down, but let's be honest, a lot of first-time home buyers don't have 20%, so they're doing 25-year mortgages. Now, the government announced that August 1st, if you're buying a brand new home, and that's kind of
new construction.
Yeah, new construction. That's what kind of annoys me. But anyways, if you're buying a new,
what first-time
home buyers
can
buying
buy a new construction home?
That's what kind of bugs
unless
me.
mom and dad got a little bit, and then, you know, well, more than a little bit.
Yeah, or
they
they're
want to throw it at them, or they're doing the
jumped,
whole backyard suite thing, and they're getting in there with them, right?
Or they're, you know, jumped into a career that's really high income. But you know, most of our first-time home buyers aren't buying new construction homes. But this is I think maybe the government's way of starting, and they're obviously trying to encourage new home construction. But anyways, I hope they switch that rule from first-time home buyers buying a new construction home can do a 30-year mortgage to just all first-time home buyers. Because the first-time home buyers, in my opinion, they're the ones struggling right now.
They are. Yeah.
They're lower salaries, higher debts, minimal savings, no equity into their home. So they're the ones that need help.
Yeah. Now, just kind of speaking on a couple of those points, obviously, those would be great things for buyers. I would definitely agree on that. The concern, I guess, that I have with, let's just say they open it up for all first-time buyers to have the 30-year mortgage.
Yeah.
So obviously, what that does for them is it increases their buying power, because now they have more access to funds.
They have a lower mortgage amount.
Right.
So they qualify for a little bit more.
For a little bit more.
Yeah.
So obviously, that'd be kind of a two-pronged thing. So if they get an extra 5 years on their mortgage term, that allows them to qualify for a bit higher. With the rates, hopefully continuing on the downtrend that we're seeing, that obviously adds to their purchasing power. Do you see that negatively impact things further because of where we are with supply, or do you see that as a net overall good thing? Because I think in my opinion, if we don't get a handle on supply and more housing starts and more inventory, then do you think, in my lens, that could maybe be detrimental inside of our immediate kind of real estate landscape here?
I agree with you. I agree with you. Like right now,
like if we don't get things improved and then we implement all these other things, then I'm afraid it's going to set us back in terms of, the craziness in the market. And there's more people out there. They got more money. They're spending a bit more. And then we get a bit more bidding and competition. And then it kind of drives our stock back down. And then it kind of bumps the house prices up a little bit further. And then we kind of continue this trend of unaffordability. And that's kind of my overall worry. I'm just wondering if you cared to comment on what you thought about that.
Like right now, and this is just generally speaking, and this is just John Vo's opinion.
Yeah.
I think people, for first-time home buyers, like the starter homes, let's say between $400 and $550.
Yeah.
I think they're kind of overpaying, in my opinion, for that. I think people that are, if you can afford a home in the 700-800 plus or whatever, you're actually getting good bang for your buck.
A better product.
Yeah.
Yeah. Where
Right?
you're 455, under 6, I find it's dated.
Yeah.
There's probably carpet,
That's
old
right.
trim. I mean, look at my upstairs, versus the downstairs we renovated. So
Yeah.
that's like, aside from the kitchen, that's like very basically original, like the
Yeah.
old crappy trim around the doors and, just dated stuff. I mean, we never had carpet, but I just find like sometimes, yeah, what they're paying for, like you say, might be a little bit more than what they're actually getting.
That's
Does that
right.
make sense?
Totally right. And especially they're coming from like
And then they
some of the
don't have the
apartments
money to renovate.
to renovate it,
Or
'cause
they
they're-
don't have
'cause
the
they're
know-it-all, or they
Yeah.
don't have the confidence, and then it kind of deters them altogether because like, we're going to pay $500K for a house that needs $50K of work. And
Yeah, especially if they're coming from one of these nice new apartment buildings. Some of these apartments are nice.
man,
You know what I mean? And it's
a downgrade.
It is a downgrade.
in lifestyle in sense of like what you're getting to live in.
Yeah.
But on the flip side, it's like, well, now you're paying your own mortgage, you're
Yes.
building your own equity. But some people, they want what they've been living in.
Yeah. Yeah.
And it's not there for what they can afford.
So I would say, like, if I could give advice to anybody getting into the home market, especially coming from renting a nice place, is that just be flexible. Don't be.
It's not forever.
No, it's not. And you can renovate things. I love renovating things. I get that not everybody wants to, but it's sure you can live for today in a nice fancy apartment with, new appliances and hardwood and granite countertops and all that stuff, but you never own it. And you might be stuck in that rut. So if you can just kind of downgrade maybe the quality, but just the pride of ownership, and then just knowing that things can be fixed, right?
Yeah. And know that whatever you're buying now, when you're ready to go, I mean, if you buy and you want to sell the next year, no, but like your product will be worth more than it is today.
Exactly. And that's how you get to the next home and the next home and the next home, right? So if you can, if you can just be a little bit more flexible, I highly recommend, patient, flexible, open-minded, willing to just, you learn. That's how I learned how to paint, learned how to, do some mild renovations, change light fixtures and certain things, change trims and stuff. You learn. It's rewarding. It sucks sometimes to live in renovations, but it's good. But anyways, that's my main advice. If you can be flexible, then in the long run, you'll thank yourself. But going back to your question, Chris, is that, if the government starts to open up rules in certain segments, like the first time buyers, like right now as it is, without rules changing, that market, I think that people are overpaying for a $400 to $550 home, in the sense that like what you're paying, what you're getting. And so if they open up that market for first home buyers, it might make it worse. But there's different things that they could do. And this is just something I just thought of. Like they could say a first time home buyer could have a 30-year mortgage. That's where you set your payments at, but you got to qualify on 25, just for example.
Yeah.
So
Kind of like the stress test.
Yeah.
Ish.
Yeah. The stress test is, so if your rate's 5%, we have to make sure that you can handle a payment at 7%. That's not your payment. Just we want to make sure that you can handle that, because that renewal, your rate could go up, and therefore your payment. So they could do the same thing. They could say, you know what, you're a first-time home buyer. Well, set the payment at 30 years because you're probably young, not necessarily, but probably, and you've got a lot of years to go, and we want to keep the payments comfortable for you because you probably have other debts or whatever. But you got to qualify at a 25. So maybe that doesn't kick it up. They can get creative in certain rules like that, right?
Right.
And I hope that they do, because I just go back to this, and it's not the first time I said it, it's the first time home buyers. I feel bad for them because it's hard to get in, but I always say once you get your first home, it's a lot easier from there because you're building up equity.
Yeah, you got more access to capital. Yeah. You got the experience. You probably improved and progressed in your career and life, and maybe paid down some of those debts, whether it's school or your car. Like,
maybe even refinance.
Yeah, and like I was sharing with you, like, I know everybody wants the nice, shiny new things, and we're human. Like, we like new stuff. I'm guilty of it, and I've been in a period of like, when I had a salary and I wanted something, well, I knew I was going to get X amount of dollars next 2 weeks, and the 2 weeks after that, and the next 2 weeks, and the next.
Yeah.
So I got in a habit where it's like, I just buy what I wanted because I knew that I could get that money back and or save it back up. So yeah, I've been, I have 2 cars. They're paid.
Yeah.
Guess what? I drive a Jetta. My wife drives a Tucson. Are they the fanciest, awesomest cars? No. Do they get us around? Yes. Do they cost us $0 a month now, aside from gas and insurance? Yeah.
Probably some maintenance too.
Yeah.
Yeah.
Is it awesome? Absolutely.
But you've made a lot of sacrifices, if you will. Like
I've had made a lot of sacrifices.
Yeah,
last 4 years, 3 years,
and good for you,
here.
right? You're a business owner. You own this home. That's great. But to your point, it's not like some of these brand new rentals. Like,
yeah,
but trust me, Chris and your wife, in later years is going to thank yourself.
Yeah, and that's
the equity that you've built up in this home is unreal.
Yeah, man. Yeah, and I guess the point I'm trying to get to is, yeah, I know you want to post the awesome, I got this brand new thing, or look at my awesome designer stuff, and just like delayed gratification, guys. Like, you can have all that stuff later.
Yeah.
Just get to a place where you can amass those things easier than just like slugging away buying it all now.
Yeah.
And maybe you have all these nice things and these nice clothes and these nice vehicles. Like, I've had clients, went for a pre-approval. He had his car paid off.
Yeah.
I knew he did good. He went, did the thing, and then he bought a new car, and then he finished the pre-approval, and then the number he had versus the number he got changed dramatically.
Right.
And he told me, he's like, oh, man, I got to just stay in this apartment. I can't make a move. I bought this car. I go, bro, I told you not to buy that car.
Yeah. So that's just it. And I've said this many times. Do you want to live for today or do you want to live for tomorrow? And there's got to be a balance. I get it.
Well, a lot of people living for today.
Yeah, that's right. And, like my old man, my dad, I think he lived for tomorrow too much. Like,
Dad never spent a cent.
I know. My dad's living pretty good now. Like, he's
Dad too.
Yeah, my dad's in his 70s, but that's the other thing too, is that sometimes people don't always make it to their 70s or their 80s or whatever, right? So I believe in a balance. And that's a big thing. I think when we were having breakfast there one time, I believe in balance in life. So yeah, you gotta live for today to a certain degree. You
don't got to deprive yourself of everything.
That's right.
But just don't buy it all.
That's right. And then but you also gotta keep in mind for tomorrow, right? This is that balance, right? Yeah. But yeah, you got to be definitely more strategic nowadays than you did in the past. Like, you had the luxury of going, maybe half of what you could afford.
That was a luxury. Looking back,
that's what I'm saying. That's a luxury. Not everybody has that luxury today.
Not today.
That's what I'm saying.
Yeah.
So,
you got to live 40 minutes outside the city to get under your budget now.
I know, right?
And most of my first-time buyers, luckily, they understood the assignment. We all thought it was going to be super challenging, but they realized quickly and early on they couldn't be where they really wanted to be right now.
Yeah.
But I think that's a lot of the realizations that people have to make. It's like, you can still live 30, 40 minutes outside the city, hop on the highway, and you're still, within earshot of what you want to do.
Yeah.
And like, maybe you're 10 years in Hubbard's or Lance or Shuby or whatever, but like, you can get back there. It's just, do you want to pay egregious rents and try and make it and save and then get to where you want to be inside the city?
Yeah.
Or do you just want to sacrifice? Maybe the commute's the sacrifice. It's a slightly older home.
Yeah.
But like, home's where you make it. Like, as long as you can make your space, what you want it to be, then, home can be anywhere. It's just.
Speaking of, this is kind of like a blast of the past in here. I like the Hulk you got here. You got some bobbleheads. It's cool, man. And that's what I mean. Like, this is I feel very comfortable here in your office and your studio, and you got a little kind of workout area here. It's like, you just want you make it. You know what I mean?
Yeah, man. It's like, and just to comment, I don't share a ton because I don't know if my mom watches these, but I know it's a big touch point for her and Dad. But in 2018, my home in Argyle burnt.
Oh, I didn't know that.
Yeah. So a lot of these, I'm sure you remember, maybe it's a little bit ahead of you, like gargoyles and like the Ninja Turtles back on my filing cabinet. And well, we used to have all that stuff. I mean, a toy chest full of this. I mean, looking back, we never thought we had anything, spoiled kids or whatever.
Yeah.
But we had like the original Ninja Turtles. Like that probably was worth a ton of money. Today.
They all got burnt in fire.
Yeah, unfortunately lost everything. Mom had Rubbermaid containers full of baby pictures. And
man.
So all that stuff that we could have shown our kids and,
Yeah.
if we were blessed to have them, it's all gone. So a lot of my decor, women may call it childish and maybe some men, but like to me, it just reminds me
it's
of
nostalgic.
Yeah, exactly. It just reminds me of the happy times in my childhood where there was less care and less worry in the world.
Yeah.
And
so where did you get them? Did you just like Value Village it or whatever?
Because once in a while I just hop on Marketplace and I'll just literally what I've been doing lately is I'll just think of stuff that I had as a child that I really liked, and I'll search it up, and if I can find it on Marketplace, I go out and buy it, and I just find a place for it and put it out. And I appreciate the comments because like my real estate business, the podcasting, my personal friendships, like, I want people to be comfortable around me, whether they're in my home with me. So whatever I can do to get there is what I try and do. And the feedback I've been getting is exactly that. So I really do appreciate that.
Oh, you're welcome.
Yeah. But, yeah, man, I know you're a busy guy. I got a couple things to do this afternoon. We've been on it for an hour and 20 minutes.
I was wondering. Okay.
So let's wrap it up. I think if some key things here is, some people can take away something from this episode. It's like, you don't have to have everything right now.
No, that's right.
Make smart choices.
Delayed gratification.
Home's where you make it. And
that's
yeah,
right.
Exactly. Practice delayed gratification. I know it's helped me a ton, especially getting started in entrepreneurship as a realtor, as a new real estate investor with the Airbnb.
Yeah.
So it just takes time, guys. Be patient.
Patience is hard. You said it at the beginning of this podcast is that with the social media and a lot of things, like everything's so instant.
Yeah.
It's like you just go on your phone and order, or you go on your phone and you find out the answer, or you whatever. But yeah, there's something to be said about just working at things, being patient, being flexible, all those things, right? Yeah, for sure.
Yeah, don't worry about what anybody else is doing. Focus on your journey. You'll get there. Just, play it the right way. So.
Awesome. Cool.
All right, my man. Thanks so much for coming on. We'll definitely have you on again with another update. We'll see how this kind of tracks out, and we'll keep a close eye and a finger on the pulse. And,
awesome.
We'll have you back, and I'm sure we'll be chatting about some deals in the future too. So.
Sounds good.
All right, man. You
Thanks,
have a
Chris.
great one.
Yeah, you too.